Welcome to the deep dive video update, the weekly video where we have to look deeper at some of the charts that I didn't use in any of the other videos to see if we're getting any insights from those charts, and also looking at some other charts that are unique just to this video. This is being prepared for Monday, March 24th. The first area is just for information. I only use this chart in this video. It's a longer term range of the VIX. Now, lately, we've been above 20 with the VIX, and when we're above 20, that means we experience negative annualized returns as the market's been under pressure. But Wednesday, Thursday, and Friday this past week, we actually closed a little bit under 20 in the high 19 range. And so that's showing that fear's subsiding a little bit. But what we get from this chart is a 50-period moving average of the VIX. And when the market's going down, we go up into a higher range. When it's going up, we go into a lower range. We have been going up later in 2024 and so far in 2025, but not above this 20 level where we're consistently above those levels for longer periods of time. And that means we're in a downtrend. But we're still looking okay, but it has been rising lately. Again, this is just to give us a bigger picture look at the movement of the VIX. Also, at the VIX, we like to look at the speed. How fast is it going up or down? When we were really coming down with the S&P, the VIX was really going up. And now we're back more to neutral as it settled down a little bit. And you can see here where we've actually dropped a little bit under 20 with the latest readings. Then I look at the VIX and do a correlation with the S&P. This is coming up a little bit here, but we only get concerned if we go above this dashed line. Sometimes this could suggest that the market is getting very nervous, and we're not necessarily seeing that in other studies that we do of the VIX and other fear gauges. But right now, this isn't giving us any insight that we're not getting from other charts. Also, we look at the VIX, and then there's like an indicator of the VIX. It's called the VVIX, or volatility of the VIX, or VIX of the VIX. And this tends to go down when the VIX goes down, and it tends to go up when the VIX is going up. Well, this just shows that the VIX is going up faster than the volatility of the VIX, or VIX of the VIX. And that just means we've been going down lately. And when we continually go up, that typically means sometimes that we're going up with the S&P, but then a lot of times when this is going down, that could mean that we're going down with the S&P. Not really cut and dry with this chart. You can't really put it in a box. It's mainly used in conjunction with other charts. And even though this has been going up as the market's been going down, we're not really breaking out of the range that we've been in over the last few years. Then we look at the skew index, and for the longest time I had to show this in the daily video because we were up in this red area. Now we're down more into the neutral area. And the reason why we watch this is you can see other times when there were spikes and then what the S&P did after that. Sometimes it marked a top, sometimes a bottom, sometimes a continuation, because this involves both calls and puts. It's what is the market skewed to at any given time. This is calculated using out of the money options, where the VIX is using at the money options, wherever the S&P is at that time, trying to project fear out 30 days into the future. Right now, this has been dropping down a little bit after giving us months of high readings, so we're not getting any additional insight right now from this. Then we look at the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And when this is going up, that means that stocks are more volatile than bonds. And that's what we've been seeing. Bonds are actually positive year to date after having a number of years where they didn't do very well. Where stocks have been under pressure, and even when we've been going up, it's been pretty lethargic with movement because the mega caps aren't really moving all that much. And a lot of that has to do with the decrease of earnings projections. They weren't as robust, or they're not as robust now as they have been in the past. So we see overall that this line is going up. That just means there's been a pickup in stock volatility in relation to bond volatility. I show this quite often, but I stopped showing it in the daily video because we're below the 200-day moving average with the large cap growth ETF. When this is really up and above the lines and doing well, that's when the stock market's going up. Now we're seeing some weakness here. We're underneath the 200-day moving average. Shorter term moving averages are starting to roll over. longer term moving averages. And so this is taking a hit right now. We need to get back above this 200-day moving average to at least have a shot of turning things more positive. You can see other times before we came down close to this longer term moving average only to bounce up from it. This time we broke down below it, and that could be an indication that things are turning in the market. We're still at that point where the market could go up from here. We're trying to stabilize and go up a little bit, and some of our daily indicators that I go through in each daily video are actually turning positive, but we're not seeing a lot of follow through right now, not an awful lot of conviction. So I haven't been showing this chart for right now. So we could see a nice little bounce up from here. We don't know what's going to happen, or this could be just a little resting spot. We could hit some resistance and then turn and really start to go down. Then we look at the relationship between risk on and risk off. And I stopped showing this because we have been dropping. And I do use this quite often in the daily videos, but we've just been kind of chopping around now at a little lower level for the last week or so. So I dropped this chart from the video. When it's going up, that means the market is more risk on, and it's usually going up at that point. When this is going down, that means we're more risk off. The market's becoming more defensive. And that typically means the S&P is going down as well. We look at the relationship between large caps and small caps. Both have been just getting hit hard, but still, the large caps are holding up better, but pulling back recently. Not getting any real insight. I'm looking for more trends overall. And when we were really going up, I was using this chart in the daily video. Now that we're just kind of chopping around a little bit, I stopped using this chart. And this is just for information. Where are we from previous significant lows that the S&P set? Well, we set a good solid low back in October 2022, and we bounced up out of that. And even with the declines, we're still up 62.18% from that low. And then we set another significant low in October of 2023, and we're still up 38.11% as of Friday's close. Then Stock Charts has technical alerts. I go through these every day in the daily video. These are the alerts for the whole week. Monday starts at the bottom and Friday ends at the top. And when we have more positive days, we see a lot of blue or green here, depending on what color you see. When they're negative, they're red. And we had an up week this week, and we're seeing some improvements. So we're seeing a lot more blue or green than we are red lately, but still the market's been under some pressure and still in a downtrend overall. Then I have 6 indicators. Or indexes. I just added a 6th one a few months ago. And I take the S&P, the NASDAQ 100, the Dow, and then I look at the NASDAQ and NASDAQ 100. That's one of the new ones. And then the mid caps and small caps. And we rate them on a scale of 0 to 100. When the score comes into the high 90s, that means it's really looking good from a technical analysis perspective. And then I rank them, what's looking the best all the way down to the worst. Well, what's looking the best right now is the Dow. And even it's not looking all that great. You see where it's at 45? It's below 50. It's not even up in the 60, 70, 80, 90 range, but it's looking the best right now at 45.6. In second place is the S&P because it not only has growth, it also has value. So it's been holding up a little bit better, but it's coming in at 31.5. Then we have the QQQs, which is the NASDAQ 100, coming in next at 22.7, and that's pretty much all growth, and growth has been under pressure. And then another area of growth is the NASDAQ itself. This is the broad market, and this is the ETF that goes with that. And it's been under pressure too, coming in at 18.7. Then we have the mid caps, which have not been doing very well at 12.8. And then in last place are the small caps coming in at 6.7. And they've been giving us a low reading now going back to the latter part of February. Then a short-term rainbow we look at here, going from 10 periods up to 50 periods with moving averages. Since we're really dropping down, we're dropping below the rainbow and the lines are rolling over. That means that the short-term trend is showing weakness. And we've spent a lot of time underneath this rainbow, and that's why we're seeing the lines rolling over. So yeah, we're concerned. We're negative in the short term, and we have been for some time, going back to the middle to latter part of February. But if we continue to go down, these lines will keep going down, and then they'll start to even out and show that we're more in a short-term downtrend. Then I dropped using the 20 period simple and exponential moving averages. I still show another version of that that uses a double and triple exponential moving average. That gives us an idea of the condition of the short-term trend. Well, since we're below both the simple and exponential moving averages here, there's been no need to show this because we're clearly in a downtrend. And then we look at the advanced decline ratio, which is actually showing a little bit of an improvement. This is short term. It's based on 19 days. And this shows that the ratio between advancers and decliners in the S&P is actually crossing, well, it's negative here. It's a little bit below zero based on price, but it's showing some improvement because it's above zero based on volume. And that's what we've been seeing for the last month or so in the market. The advanced decline lines have been holding up, and it's not because money's coming out of the stock market. It's because it's coming out of the one area that's growth, especially the mega caps, and going into more value areas. So it's just shifting from one place to the other. And that's why volume is doing a little bit better now than price, because we've been underwater lately based on price. Intermediate term rainbow going from 50 periods up to 100 periods. We're also below the rainbow and the lines are starting to roll over now. So this is suggesting more damage is being done the longer we stay underneath this rainbow to the intermediate term trend. Then I often show this, and it's not an apples to apples comparison. It's kind of an apples to oranges comparison, where we look at the S&P 500, which is one index, and then the NYSE advanced decline line, which is a broader market advanced decline line study, and then just compare the two. Now they're on different scales, but when the red line is above the bar chart, that means the broader market is outperforming the S&P. Well, then it started to drop down below, but now it's coming back and actually starting to outperform a little bit as we're seeing parts of the value areas of the NYSE holding up better than the S&P 500 currently. Then here's the 50 period moving average. The same reason here. We dropped below it. We're well below the lines. I use a double and triple exponential moving average to look at the condition of the intermediate term trend. And I haven't really seen a need to include this in the videos unless we start coming back closer to these moving average lines. Same thing with the 100 period moving average. It held as support for a while. We broke that. Now we're trying to come back up. I'll put these back in the daily video if we come back up to the moving average lines. And then this is the boom indicator. It comes in and out of the video on an as needed basis. This measures how far are we above or below the 20, 50, or 200-day moving average. Now we were really coming down fast and fierce, and this is like an oscillator. When we drop below this red line, that means we're getting too far away from the moving average, and we have a tendency to move back, and that's what's been happening lately. We also measure that with the 50 period moving average. We had got pretty far away from that, and now we're starting to come back. And then when we drop below the 200-day moving average, we're getting a reading below zero here, and we'll try to get that back if we have a chance of at least turning more positive. Then standard deviation, I was using this chart heavily over the last 10 periods as we were really coming down pretty quickly. This was giving us very high readings, but now the last 10 periods are including lower values here and higher values on the right-hand side, more current, and that's why we're seeing a real decrease. This doesn't measure direction. It just measures speed. How fast are we going? And the Pring bottom fisher was getting really close to generating a buy signal. That's when the black line crosses above the red line. It didn't quite get there, and now we're dropping down, so I stopped showing this in the daily video. There's still another buy signal that we're looking at called the mass index, and that has the potential of triggering. But I was showing both of these, and they seem to be lining up together with each other about the same time, which doesn't happen very often. Now we're not seeing that as the Pring bottom fisher potential buy signal is going away, but we're still watching the mass index. This is the Connors RSI, which works very similar to a regular RSI, and you can see how jumbled up we are here. We usually get bigger swings, but I only use this when we get above this upper black line or below this lower black line because it does gyrate all over the place. But you can see we're not seeing an awful lot of movement. It's pretty contained right now as there's been a lack of conviction in the market. This is a newer chart called the bow tie. It's similar to a moving average rainbow, where it's shorter term in that there's a 10 period exponential moving average. So that moves quicker than a simple moving average. That's why they use those. And then we have a 20 period exponential moving average and then a 30 period exponential moving average. And this just shows if the green is above the red and above the blue, we're in an uptrend. Well, we're seeing the opposite of that right now. We're below all of the lines, and the lines show the green on bottom, red in the middle, and then blue on top. And that just also confirms that we are in a downtrend. If we can get back above this green line here and start to go up, that has the potential of turning things more positive. And then this is another look at the trend. And you can see we're still in a downtrend right now, according to this chart, even though we've been trying to bounce back up lately. This also measures when we're in an uptrend and it's green. And then these little short trends here just means the market really hasn't been moving all that much. Then this kind of does the same basic thing. It's called a proper order, where when we're in an uptrend, we're green in the background and going up. And then in a downtrend, it's red, and then blue with the green black background. Well, this is picking up that we're still in a downtrend and it's still red. So this hasn't turned over to show the attempted bounce that the market is trying to make right now. This measures volatility in a little different way. Usually we look at the VIX, and I have a couple of other charts that try to measure fear in the market as a whole. This is plotted right on the S&P. Now the VIX is plotted on the S&P 500 too, and is the skew index as well. But this is another attempt at looking at volatility. It was getting up pretty high, and it's still high. When we're going up, this line has a tendency to drop, meaning there's less volatility. And now we're up in the higher range, but we haven't been seeing big swings with this. So I haven't been using this in the video. And then this is just how far we from the all-time high that was set back in February. We got just about up to that 10% level. Now this is on a closing basis. The chart that I'm going to show you in a minute, I use an intraday measurement for that chart. And this is when everybody's like, oh my gosh, 10%, 10%, because that's the definition of a correction. Now, if we go down 20%, that's when we're technically in a bear market at that point. But we got down to that 10% level, and we've been trying to bounce up since then. Now, if we start to fall again and go down over 10%, that means things are turning more negative longer term. But for right now, they're holding under that 10% level. We're down 7.76% from the previous all-time closing high set back on February 19th. And this also measures that we're below the 200-day moving average. And when this was happening, I was showing this chart all the time. Now that we're below this and not really coming back up, at least yet, I stopped showing this chart in the video. This is a CMB composite. It's also an oscillator. When we get above, and notice how it's coming up lately. It's been picking up a lot of this recent bounce that we've been seeing. But I only use this when we go above the black line. That means we're extreme positive, or below the black line here. In the end of February, we had an extreme negative reading, but that didn't really mean much. That the market just kept going down after that. So I use this in conjunction with other charts. Then we look at the percent B indicator, and it measures whether we're closing above or below the upper or lower Bollinger Band. We were close, and we stayed near this lower Bollinger Band for a few days, but now the band is starting to turn back up as price has been going back up. And so we're seeing this still negative since it's below zero, but it has been showing some improvement. We look at the S&P 100 and compare it with the S&P 500. Even though the S&P 100 has been underperforming on a ratio basis, we're not seeing price really getting out of line with each other. And that's really what I'm looking for on this chart. If one is going down more than the other or up more than the other, that's a divergence that we're trying to see, but not really seeing that currently. Point and figure chart, there were some signals throughout the week, and we did have some buy signals generated on the weekly version. But here we did see some X's coming back in as we were bouncing back up, but no recent signals, so I included this in the chart. When we're going down, O's are drawn. When we're going up, X's are drawn. And this doesn't take time into account. It's how much has it moved. And it could take a day, it could take a year. And if it moves up by a certain amount, then an X is drawn in. If it moves down by a certain amount, then an O is drawn in. And this is still looking positive overall because we have this blue trend line that's going up here. But yeah, there's been some real damage done to the S&P through this latest drop. A long-term rainbow goes from 50 periods up to 250 periods. We're still a little bit below the rainbow here, and the shorter moving averages are starting to roll over. The more we stay down here, the more these lines are going to roll over, and the more the long-term trend is looking more vulnerable. Then this actually triggered, and I was showing it for a few days before and after it triggered, but now we don't get very many signals here. This is long-term negative. This is the special K. It's an oscillator, but the last signal that we got was at late 2023. And then we've been above this red line for the whole time. Now we've dropped down below. And this could end up being longer term negative. Just for reference, the weekly chart that I show in the weekly video, it's still positive, but starting to roll over itself. And this I was showing quite a while. This is a trend channel going back to 2009. And when we hit the upper end of this, that's when we really started to slow down. And then when we slowed down, we got into 2025, and now we've been declining since then. And if we do go back up, this could provide some longer term overhead resistance. Then we look at the weekly chart of the S&P and a weekly chart of the German DAX. And Germany's been doing really good, where the US has not been doing good. And so we're seeing this correlation really falling off right now. They're almost in opposition to each other, where they have a more of a tendency to go in the same direction at the same time, whether up or down. Then some support and resistance levels. Now, this is a short-term chart, but it really gives us more of an intermediate term perspective because this is a 20-period moving average, which is short term of the open, high, low, close. And that produces this little mini rainbow. And we've dropped below the rainbow and we're going down and the lines are going down. Now, one of these lines, if we start to bounce back up, it may provide overhead resistance. So if we start to bump in, we're already into one of these lines. But if we go up into the rainbow and then we stop and come back down, I'll be putting this chart back in the daily video. This is another support area called an Ichimoku cloud. We're below the green cloud. Then we see that the green line, which is short term, it's been going sideways. That's what we've been bouncing. But more intermediate term is the blue line. That's going down and it's below the red line. In a more positive environment, the blue line would be above the red line. Now, if we do start to go back up, parts of this cloud may also provide overhead resistance, but that would be a pretty significant move because we've dropped really far below the cloud. We would get almost back up into the 6,000 range here for us to even hit the lower side of the cloud. A broad market measure, this is the Vixen. Gotta love that name. It's the VIX for the NASDAQ 100. They just have to change it around a little bit. And I don't use this all that much, but I know some of you that watch these videos do trade the NASDAQ 100. I just focus on the S&P. And so you found this chart to be useful from time to time. Then the QQQs, which is the ETF for the NASDAQ 100, still underneath its 200-day moving average. So I stopped showing that. I was showing it while we were coming down here. But now it's turning even a little bit more negative because the 20-period moving average has crossed below the 50. And now it's starting to cross below the 200. And so these lines are coming down and crossing over each other, and that just shows more vulnerability to the upside. Then we look at the S&P on top, and then we do a growth to value ratio down below, the Qs to the Dow, and it's pretty much neutral when we compare the top chart with the middle chart. We're not really seeing any leaning one way or the other, as the market seems rather confused and lacks conviction right now. Then we keep an eye on the Dow and the transports. The transports have been under a lot of pressure lately, and that's the red line, where the Dow also has been under pressure, but the transports have been going down even more, and the Dow is the black line. It's more beneficial for the economy and for the stock market if we see the red line, transports, outperforming the Dow, which it has done in the past, but it's not doing that right now. If anything, it's outperforming to the downside. We want to keep an eye in the financial sector to see if there's any clues that there are problems there, similar to what we saw in late 2007 going into 2008. That's the financial sector. Then we want to keep an eye on the smaller banks. That's the regional banking ETF. This is going down now. So we're seeing regional banks under pressure compared to the financial sector. Now, the financial sector has been getting hit with everything else lately, but it's been bouncing back. It hasn't come down to its 200-day moving average. It's holding up better by itself, and that's encouraging. What's discouraging by this is that the regional banks are getting hit when compared to the financial sector itself. Then a rate of change chart here going back 250 periods. We came up above this blue line. That's a warning sign to us that maybe we've gone up a little too far. Well, that happened this time. We've gone up even way above the blue line in the past, but now we're coming down. And this is just showing longer term. We're seeing more deterioration in the market as well. We keep an eye on bonds. And now the big thing that folks are worried about is inflation, but we're not necessarily seeing that reflected in the charts right now. One chart that we look at is cash, which is 1 to 3 month T-bills, and then we compare it to 3 to 7 year bonds. When this is going up, that means there's uncertainty about inflation and interest rates. Now it's coming down. Now we're still in an uptrend because it had been going up for a while in late 2024. But so far in 2025, this ratio has been coming down to its 200-day moving average. So if this market was concerned about inflation and interest rates, this ratio would still be going up, and it's been coming down. We use that same approach with TIPS. Now, these are Treasury inflation protected securities, which adjust their interest rates. And this is what people get into when inflation and interest rates are going up. Well, we've been just chopping around. We're not really moving around all that much lately. So we did start to go up back in February when the market started to head lower. But since that time, we've dropped back down to the moving averages here. So there's really no concern with this chart. And then we do that same thing looking further out with tips to 7 to 10 year bonds. The previous one was 3 to 7 year bonds. This had been going up, which was causing inflation concerns. Now it's been coming down. So the market's not really seeing that. Then we look at the long-term bond ETF, that's 30 years, 20 to 30 years. That's in blue. And then the S&P 500, which is in red. And we look at the long-term correlation, which is, you can see they've been going in opposite directions. So that's why we're seeing a weakening of the long-term correlation. The short-term correlation is neutral, but showing that they're having more of a tendency to go in the same direction. So if the 30-year bond's going up lately, and the S&P is going up, then this correlation gets stronger. If they're both going down, this relationship also gets stronger. It doesn't measure direction. It just measures, are they moving more in tandem with each other? And you do that same thing with the Qs. And this is actually going in opposite directions right now, after it had been neutral here for a number of days. Then we do kind of an interesting study here. We look at the 10-year yield in Germany, which has been going up, and the 10-year yield, excuse me, first we look at the US, and then we look at the German yield, and that gives us a result, which is above the red line because US rates are higher than German rates. And then we plot the US dollar index, and then we look at a correlation between the top chart and the middle chart. You can see there's a pretty high correlation here. Now, we're not really freaked out by this. This is more normal. This is usually what we see. If we really start to get out of line here with this correlation, then that's when we start to get concerned. Then we look at the 2-year yield, which is shorter term. It's been chopping around. Sometimes when we spike up and come down, that gives short to intermediate term support to the S&P. Well, it hasn't really been moving all that much lately. And we look at the Eurozone, those are stocks in Europe, and compare it with US bonds. And Europe has really been doing well lately as the US has been under pressure. And so that's why we're seeing this ratio going up. And interest rates have been coming down. That also pushes this ratio up. Then I have a number of things called possible positive scenarios. And this first one is just the percent of stocks in the S&P above their 200-day simple moving average. Now I have another chart that I show pretty much in every daily video. It's the same thing, but it's just presented in a different way. So it gives us a little bit of a different perspective. I use this like an oscillator. When we get an extreme positive or negative reading, we're certainly not getting that now. And when we're above or below 50, well, we're seeing that in the other chart that I use. So I stopped using this chart. This just shows that less than half of the stocks in the S&P 500 are above their 200-day moving average. And that's where the weakness is coming in. And then we use that same basic idea with those stocks above their 50-period moving average, also the negative reading. use this like an oscillator, but not getting any signals. And then to give us a little more of a broad market perspective, we look at the mid caps, also looking more negative, and then the small caps as well. Now, if we get down here below this red line, that could mark some kind of a bottom. That means we're getting extreme negative. We're close, but we're not there yet. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post because this is just meant to be a piece of a larger picture in what I try to present every week. So have a great weekend, and I will talk to you in the next video.